Sitting down again with Eileen Craig at City Sky Mortgages, who sits with us in our office over at Nesters, and we're going through some mortgage broking ideas and different types of mortgages. And today we're actually going to talk about first-time home buyers and some of the things that you could do as a first-time home buyer to purchase your first home, and how to really focus on that and how to take best advantage of some of the different things and make it work.
Perfect. Okay. So, first-time home buyers, it's a scary spot for you guys. It's you're going to make your first really big investment. So,
yeah, and I'll say that our job is to make it easy.
Yes.
And stress-free.
Yes.
So lean on us. That's okay.
Yes. Yeah. Let us have the stress. Yes.
Yeah. We've done this a few times, so it's okay.
Yeah. So, first-time buyer. You're going to do the same thing that we would do with any regular buyer. We're going to take your full financial information, confirm your income, check your credit, make sure that everything's up to date, and then we're going to look at mortgages for you. So as a first-time buyer, you probably haven't got a huge amount of money to put down. Most of us don't. And Canada has a couple programs to help us get into our first home. We can get into our first home with as little as 5% down. And the average down payment for a conventional mortgage, a regular mortgage, is 20%. And with 20% down and good credit and good income, the bank doesn't need any additional security for the mortgage. But if you've got less than 20% down, which is most of us, the bank's going to require some additional security. So your mortgage is going to have to be insured by either CMHC, Canada Mortgage and Housing, Genworth Financial, or Canada Guarantee. And this insurance is not for you. The insurance is actually for the bank. The bank is only allowed to lend 80% financing on a property. If they're going to lend more, that mortgage has to be insured. And this is default insurance. This is insurance in case you can't make your payment. So you've got your 5% down. So this is actually you're going to have two approvals. You're going to have the bank's approval, and you're also going to have the insurer's approval. So the bank is going to look at you and say, yes, you've got good credit, you've got your 5% down, you've got enough income, and they'll approve you. But there needs to be an additional approval from CMHC or Genworth, and they're going to look at you, and they're going to look at the property. So they're going to be the ones, because they're insuring the property for the bank.
Okay, so CMHC, Genworth, and
Canada Guarantee.
Okay, are they government?
Only Canada Mortgage and Housing is. CMHC.
CMHC is.
The other ones are private.
They're private,
insurers.
so they are insurance companies.
Yes.
Okay, and you're paying for the insurance payment on it.
Yes.
And but that is for if you cannot pay your mortgage and you're defaulting on your mortgage, the government requires it if you don't have a 20% deposit.
Correct.
And you only have a 5% deposit.
Yes.
Of your total purchase price.
Yes.
Yeah. So you can still purchase with only 5% of your purchase price.
Correct.
But it has to have this insurance payment.
It does. And this insurance premium is currently 4% of the mortgage amount at 5% down. So if you've got 5% down, you're going to have a 4% insurance premium. That premium is going to be added to your mortgage. So you don't come up with that money yourself.
You don't add it. It's not added to your monthly payments. But let's say it's $10,000. It gets topped up onto the top of your mortgage amount that you're borrowing.
Yes.
So if your purchase price is $400,000, then that's $410,000 is your mortgage.
Correct.
Okay.
And your payments will be calculated on that.
And your payments are calculated on $410,000. Okay.
So the maximum amortization on an insured mortgage is 25 years.
Okay.
They can't be insured. They can't be any longer than that. The qualifying rate for an insured mortgage is always the bank's benchmark rate, which is what they base their lending off of, their base fixed rate, and currently that's 5.34. So even though our best mortgage rate right now for an insured mortgage is 3.19, you have to qualify at a rate of 5.34.
So I think that means that you have to be able to afford the payments at 5.34% to get approved,
Yes.
even though you can sign up for a mortgage that's lower.
That's right. And that's the government's way of making sure that if rates go that high, which they have been that high in the past, that you can still afford it.
Okay.
And that's
So
the
they're
reason behind it.
being dad.
Yes.
You're saying dad,
They're
that's
being dad.
making sure that you can afford it, so that they
That's right.
afford this, you can afford that, then, okay, go
Yeah.
ahead.
Yeah.
All right.
One of the other perks for a first-time home buyer is that you can access your RSPs for your down payment. And that's called a first-time home buyer's withdrawal. So up until yesterday, you could take $25,000 out of your RSP and put it down as, without paying tax, you could put that down as your down payment on your first home. As of yesterday's budget, this is March 2019, you can now pull out $35,000 out of your RSP
That's
to go
good.
down as your,
$10,000.
yep,
That can be very helpful.
yeah, totally can. So the home buyer's plan, you'll go to your investor, your RSP holder, and you will let them know that you're purchasing your first home, and they'll have you fill out a home buyer's withdrawal form. And that will allow that money to be taken out of your RSP tax-free. Now that money needs to be paid back to your RSP, and you have 15 years to do that.
Oh,
So
okay.
there you go.
15 years.
And you need to start making those payments a year after you take, in the year following that you've taken the RSP.
Okay, and they're not saying how much or
Nope,
whatever.
you have
They just
15
say,
years.
you just have to say, okay, this is going towards my,
Exactly, when you file your taxes.
okay.
You put in your money to your RSP, a
Okay.
portion of that will be deducted.
Okay,
Yeah.
that's helpful. All right.
Another perk for first-time home buyers is property transfer tax exemption.
Oh,
So as a first-time home buyer, you can purchase your first home as long as the purchase price is less than $500,000 without paying property transfer tax. So that's a one-time exemption. There's a partial exemption up to $525,000 purchase price, but it's a really partial exemption. You're paying.
that's
most
only
of
not
that.
a lot of money either, 25,000.
Yeah.
So the property transfer tax is 1% of the first 200,000 and 2% of the balance. So you can imagine how significant that is if your purchase price is 500,000. You know, looking at that there. So if you're a first-time home buyer and you don't have to add that on to your cost, because you can't add that to your mortgage amount that you're borrowing,
That's
right? Then that's significant, not having to pay that.
Yeah.
So that's a nice perk.
As a first-time home buyer, you're going to want to know that there are closing costs, because this is something
Right.
I didn't know the first time I bought my first home. Nobody told me that. So there's going to be legal fees. A lawyer is used, or a notary, to set up your mortgage and register your property in your name. And so your legal fees are going to be
About $1,500 I got a price on recently.
okay.
Yeah,
So-
$1,500 for a Canadian resident to do the transfer of the property into your name as well as the mortgage. So that's two legal transactions according to the lawyer, just so you know.
Okay.
So that's about $1,500, including some of the costs that are associated with it.
On an insured mortgage, the lender is required to show that you have 1.5% of the purchase price available for closing costs, even though,
So you got your deposit.
yeah,
If you're over $500,000, you've got to show that you've got your property transfer tax and your legal fees. And
well, and your legal fees would be part of this 1.5%.
and so is the deposit 1.5? No. So it's just your property transfer tax and your legal fees have to be 1.5% of your purchase price.
They've used this 1.5% as a
Rule
guide.
of thumb?
Yeah, as a
Okay.
rule of thumb, and there's some wiggle room.
I think I need to write all this down. Anyway, I'm sure Eileen's got a little booklet or something that we can attach or...
We do have first-time home buyer information for sure.
That would be
The other thing that we need to remind people of is that 5% down is only good up to a purchase price of $500,000. After $500,000, it's 10% up to $1 million. So $1 million is the limit of an insured mortgage. Yeah.
Okay.
If your purchase price is higher than $1 million, you need to put the minimum 20% down.
So what we'll do, actually, I think, is that we'll put a little link down below here. Is that if you'd like that information, you can click here, And then Eileen will be able to follow up with you and send you that information.
That'd be
Or,
perfect.
yeah.
Yeah.
So we'll be able to take care of that for you so you can get all those things. And maybe you'll have some more questions because she's the expert. Okay?
Okay.
All right, so does that seem like the nuts and bolts of the first-time home buyers?
Yes, it does.
Okay. In previous emails, Eileen and I had talked about just the mortgage itself, mortgages themselves, how they are different than other areas, in, like, for example, the States, if you want to understand that a little bit. And we've also talked about what mortgage brokers do, so you can go back and have a look at those if you like, to be able to understand that process. Okay, well, thank you for joining us today, the Eileen and Denise show, and call or email